5-star copies all. Go ahead. Message to observer. Alpha 3 rounds. AT delay in effect. 3 guns. Bravo 2 rounds. 2 guns. Smoke on effect.
Hey, what's up, y'all? Thanks for watching another video from the Options Moon, our community home of the #1 educational resource on YouTube. I am Andrew, and today we're going to be talking about iron condors. If you found this video via a search for iron condors, then well done. You've already started your path to learning about short premium and iron condors in general. And in this video, we're going to define what an iron condor is and then how to manage and hedge the position. And also, if you haven't already, please go over and check out these prior videos about writing premium. They'll get you a good base understanding of writing premium before we get into the advanced techniques that we're going to discuss here in this video. So the textbook definition of an iron condor, straight out of Investopedia.com, is an option strategy consisting of 2 puts and 2 calls with 4 strike prices, all with the same expiration date. The iron condor earns maximum amount of profit when the underlying asset closes between the middle strike prices at expiration. And to break this down into visual terms, let's go over an example. And for this example, we're going to use SPX. Now, side note, I choose to write all my premium on SPX and SPX alone. Why? Because of assignment risk on other shares. Is assignment necessarily bad? No. However, with my shareholdings, I want to be able to hold on to my shares. I don't like giving them up in the risk of assignment. And I just like dealing with cash assignment, which is only SPX here. So that's why I usually, 99% of the time, exclusively trade SPX for short options. So having said that, let's get in here. For this particular example, I'm going to be talking about a weekly expiration or a 5 DTE expiration. Now, normally I open these on Monday for a Friday expiration, which is a week long. And because of that, I'm going to put a little line here to designate Monday, start of the week right here. And then this will be the end of the week, Friday at the bell. All right, so we've got our chart set up here. What does an iron condor actually look like? So the price here is $41.90. What an iron condor is a call credit spread to the north and a put credit spread to the south. So you want the short legs to be closer to the money and the long legs to be further away from the money. So let's say in this example, on Monday, I do not think the market is going to go over 4,200. So I would place a short call at 4,200. And then, depending on the width, most of the time I go about 30 wide, I would place a long call up further away from the money. So a 30 wide from a 4,200 would be 4,230. And that would be the call credit side of things. A 30 wide, 4,200, 4,230, Friday expiration call credit spread. So let's say at the same time on Monday, I do not think that the market is going to go below, let's say 40.40. So I would come down here and I would sell a put at 40.40. And then just as above, I would also long a put that's further away from the money, in this case a 30 wide, down here to 40.10. So what we have here is a 4,200, 4,230 call credit spread, 40.40, 40.10 put credit spread, together making an iron condor with Friday expiration, 5 DTE iron condor. So visually, that's what this looks like. Now let's talk about money, moolah, dinero. So what makes this a credit spread is that the short positions or the short call, short put that you're placing are closer to the money. And naturally with options, if you are closer to the money, those positions are going to be higher priced than the further away from the money. Closer to the money is higher, further away from the money is cheaper. So what does that mean for our position? Well, let's just say in this instance, the short calls are $5 a piece. And let's say the long calls are $1 a piece. So that would net you a net credit of $4 per contract. 5 minus 1 is 4. You take the short leg of $5 that you shorted, you take the long leg of $1 that you longed, you net those out, you get a $4 credit per contract or $400 per contract. So if you sold 10 of these, you would make $4,000 of credit per week. Now conversely, on the short put, let's say the short put is $6 per leg. And let's say the long put is $2 per leg. You net those out, you also get $4 per leg for a net credit. So in total, since you sold $4 of credit from here, $4 of credit from this leg, total you have $8 of credit on for the entire week for the entire position, or $800 per contract. If you sold 10 contracts per leg, you're talking about $8,000 per week in net credit. Now, in order to get decent premium for these positions, you're going to want to put it on early in the week. And then you see, obviously, you want the price of the underlying, in this case SPX, you want it to finish under your short call and over your short put, somewhere in here. It can go up and down, all the way. It can come all the way to your short call and then follow all the way down by Friday. But by Friday, you want it to close in between your short legs, your short put and your short call, somewhere in here. As long as it does, you collect 100% of your call credit spread and 100% of your put credit spread. So this sounds great, grand, and wonderful, right? You mean to tell me that I can just put on $8,000 worth of credit on Monday and kick back and relax and make $8,000 a week? Well, yeah, but just as in all things in trading, it's not as easy as it sounds. So now let's get into the management of iron condors. So iron condors or writing premium in general can be a fantastic way to drive consistent income week after week, month after month. However, if you've spent any time in the premium writing community, I'm sure you've heard the term of picking up pennies in front of a freight train or in front of a steamroller. And that can be right if you do not know how to manage the position, because if you get challenged directionally on some short premium and you don't know what you're doing or you don't know how to manage, the losses can be substantial, quite larger than positions that you would use on long options. And that's the problem. That's where people really start to kind of shy away from writing premium, because the first time they do it and they don't know how to manage and the market challenges their position, they get blown out. So I'm going to start out this conversation with saying, if you've never written premium before, please paper trade transactions so you can understand what happens when you are wrong. As with all things investing, especially with the new interest in investing by young investors the past 3 years, a very common mistake by the beginner or amateur investor is that they do not account for risk or from the fact when they're inevitably wrong, just like as we all are as investors. There's no way to prevent losses, but there is a way to manage your losses and your downside. All right, so having said that, what does it look like when things go wrong? This example here is a perfect textbook example of an iron condor. You put it on, the price action stays pretty flat, you collect a premium, you go about your day, you have a great week, right? Well, it's not always that case. In fact, it only happens this way probably 20% of the time. 80% of the time, you're probably getting a little uncomfortable and at least have to think about hedging, if not actually hedging the position. And here's a great example of when things go wrong. All right, so here's the same iron condor placed on a different time frame. These are the same strikes, about 30 wide, about the same distance away from strike. So Monday opens, I think the market's not going to go over 40-30, so I place a 40-30, 40-60, 30 wide call credit spread. I don't think the market's going to fall below 39.20, so I place a 30 wide, 39.20, 38.90 put credit spread down south. Things are looking great. The market falls off. Here's Monday. Here's Tuesday. I never really get uncomfortable here because the momentum is pretty slow. The market starts to bounce. Great. Both legs are doing very well, right? Well, then on Wednesday, the market opens, huge gap up, and then the market rallies Wednesday, Thursday, Friday. Now, the price action has breached the short leg, and it has come climbing up even deeper in the money, in beyond the long leg into the 4100. Now, this is worst case scenario for a call credit spread. You're going to face substantial losses if you were to sit here and do nothing while this price action breaches the short leg and goes on through. Because if you are long call, what happens here? If you're in a long position, if you're just some jabroni down here that puts on a long option and that's it, you want the position to go higher and higher and higher, right? Because that premium, maybe you put on like a $2 premium here and it goes $4, $6, $8, $10, $12, right? Oh, you've got a 700% win up here, right? You do not want the premium to go higher on short premium because you're selling credit, right? Well, this $4 credit that you have sold has now turned into 8, and then 10, and then 12, and then 20, and then 25, and now you're facing 2, 3, 4,000% losses on a call credit spread. It will absolutely destroy your position and your account if you were to sit here and do nothing and just watch this position go against you. All right, so if this were to happen, what do? I'm going to give you 4 different ways to manage trades such as this to allow you to get out of losses before they accumulate to some massive drawdowns. The first one is just close the position. That's the best and easiest way to hedge, and the one I recommend for most everybody, especially if you are in the infancy of your learning how to do iron condors. It's just close the position. When you start to see things go against you, just close it. Be done with it, cut your losses, and focus on different things. The second rule, and a very common rule, is to set a 200% stop loss on each leg and just forget about it. Go about your day, go about doing your other strategies like scalping and day trading and swing trading, and then just trade elsewhere. Nice and easy, right? The third way is to scalp longer DTEs against the position, which means you leave the position on, and then you take a little bit longer DTE, like a 2 or 3 DTE, and you scalp profits against the position. So as it starts to come up here, you would scalp like a 2 or 3 DTE call against the position just to accumulate profits to offset your losses. And the fourth one, and the most advanced technique, and the one that I utilize most often, is to hedge directionally or delta hedge in the direction of price action. And what does that mean? When you put on these positions, you are shorting and longing a delta for a net delta on your portfolio. In this instance of riding condors, your portfolio is going to be net short delta, which means as its price action is going up, you're going to be losing money because you are short calls, not long calls. So in order to get you back into profitability, you need to start longing calls or longing delta to flip your portfolio into positive delta territory so you can start making money on the upside. So in this instance, I would be wanting to go closer to the money and be looking somewhere between 4,000 and 40.20 call strikes and longing enough of these call contracts to flip my portfolio to positive delta. So as this price action goes higher, I'm still making money. Now this position would still be losing money, but my net P&L on my brokerage account will be making money because my account is long delta. Now, in addition to that, there is a certain point where if I see price action that's this aggressive, that I would just simply close out this position here, leave this position on and let that eat, because that's a long call, right? Now I just got a long call on, easy peasy, and I'll just let that thing eat for nice profits, and that'll offset any of my losses. But this fourth method, and this is where you can get into a deeper conversation of a lot of advanced theories on how to hedge, because iron condors, there are multiple ways to skin the cat. There are multiple ways to make this position profitable. But when holding an iron condor, the worst thing you could do is be fearful and sedentary. Don't sit here and clench and be very fearful of being breached. You just simply have to manage the position, manage your deltas and your premiums to get your portfolio making money in the direction of travel. Just like all things, ego, fear, emotions are your worst enemy. And I'm going to finish off the management of iron condors with one last thought. And this last thought is really what makes trading premium, or iron condors in general, exceptionally hard. And it's something that I call the bait and switch. So as we talked about before, as long as this price closes Friday in between your short legs, you get 100% profit, right? It doesn't matter how big the losses are up here. As long as this price falls back down before Friday, you get 100% profit. It expires worthless because theta eats away the position. It's outside the money. You close worthless, you get 100% profit. So what happens when the position rallies against your short call, making this about a 2 to 3, maybe even a 400% loss, and you're fearful, you're sweating, your P&L is taking a beating, you're losing a lot of money, but then the price action rejects and comes back down before Friday, and making this position that was very, very red now 100% profitable. Well, that really signifies the importance of hedging. If you can hedge the position delta long here to make money on the upside, then you close your hedges, and once you see the position is falling back down, you can just hold the original position and make money. But where the bait and switch comes in is when this happens so often to you and you hold the position, it comes back down and make money, is that now it gets you hopeful when this happens. So you think, yes, I am down 5, 6, 700% here, but I know as long as this market falls back down before Friday, that this 600, 700% loss that I'm facing, this massive loss that I'm facing, will eventually decay back down into zero, and I'll just make 100% profit. However, it just keeps on going, and you get dug deeper and deeper into a hole until you've blown up your account, you've blown up the position, you've blown up your emotions, you've had a terrible week, and now you're ready to quit. That's called the bait and switch, because it keeps you in the trade longer than you want to be, with the hope, keyword there is hope, which is a terrible, terrible word in trading, that it'll fall back down and become extrinsic again. Above the short leg is in the money is intrinsic, outside of the money is extrinsic. It gets you hopeful for the price to become extrinsic outside of the money before the expiration. So now that we've talked about managing a trade, we're going to finish off this video with risk mitigation. When you are setting up the original trade, how can you mitigate your risk? How can you minimize your losses on the front end? Well, there are a couple ways to do that. The first one is your width. How wide do you go on your spreads? What do I mean? Right now, I am explaining a 30 wide credit spread, which means 30 wide call credit spread, 30 wide put credit spread. But if you want to reduce your losses or reduce your exposure, reduce your risk, you can make this tighter. You can make this like a 10 wide, which would make this about 40 right here. That's a 10 wide. What this does is it allows your deltas, your long deltas, to become closer to short deltas and gives you a little bit more protection, because obviously if this were to happen, this long leg being closer to the money is going to provide you more protection than this out here, because this premium out here further away from the money is not going to give you as much premium pump until it goes in the money, whereas this one would give you a lot of protection. Your max loss, your drawdowns, is going to be a lot less when the position is tighter rather than it being wider. So if you want to reduce your exposure, reduce the spreads to a lot tighter, 5 and 10 wide. Do not start going wider to 20, 30, 40 wide unless you have max experience, and it of course account to hedge the position. The next thing you can do is go further out in money. So instead of going for a $4 credit, you can go for like a $2 credit or a $1 credit even. You can go way out here. You can do a 10 or 20 wide that's even further away from the money. So that's a combination. You could do either or a combination of both. Go wider and tighter on your spreads. And the next way to risk mitigate this position takes a little bit of experience and know-how. Once you've been doing this long enough, you know that you can actually tranche into this position. What does that mean? It's just a fancy way of saying you could buy this in pieces. So on Monday, you don't have to put on the PCS and the CCS all at once. You can leg in or tranche into the position. So as the market spikes up this way, then I'll place this. Only the call credit spread. And then the market falls all the way back down by Tuesday here, making put premiums higher because we're lower. Then I'll put on this leg. So you put in the call credit spread first, the position falls, you put on the PCS second. Now you have the entire iron condor on tranched in individually. And this gives you a little bit more efficient pricing and max pricing for the market movement. That way you don't put on a PCS up here, the market falls, and then you're automatically in a loss. You play the outlier extremes of the market. And you kind of stiff arm the market. As the market moves higher, you stiff arm the market further out. You put on the call credit spread higher, and then the market falls down. You stiff arm the market lower, and you put on the PCS lower. And now you've got a nice, efficient, maximized credit for your iron condor. But that's where I'm going to wrap up this video. Obviously, the topic of iron condors is very advanced. You could talk about all things related to iron condors for hours and hours and hours. For example, margin requirements, cash balances, recommended balances to start these things, and on and on and on. But I wanted to get this video out there to really expose you to the idea of iron condors. It's a fantastic way to drive consistent income, not growth, but income. If you've been a part of the community before, or if you're new to the community, I've been talking about ever-changing market conditions. I've been doing this for over a decade. If you want to be successful day in and day out, year in and year out, decade in and decade out, is you have to learn to ebb and flow with the market conditions. Scalping is not a fruitful way to trade long-term. Scalping was possible in 2020 to 2022, but we can already see in 2023 what happens when the volatility leaves the market and what we are going to be facing after the volatility leaves for good, whether it be this year or next year. And iron condors is a way to drive income and some profitability when the volatility is there and there's not really much else to scalp. Always think long-term, always look to refine your edge, sharpen that axe, and learn some different techniques. Hope you enjoyed this video. Again, I'm Andrew from the Options Millionaire community. If you haven't already, come out and join the server. It's one of the best educational resources out there. We pride ourselves on being a collective, professional atmosphere where we can get together, discuss ideas, trade thoughts, and have a little fun along the way. And of course, hit that like and subscribe button on the YouTube channel. It'll get you notifications for all future content, as well as our Monday, Wednesday, Friday live streams. If you're interested in refining that mental edge as well, you could listen to us over on Spotify. We have the Making Millionaires podcast, where we discuss all things emotional related to trading to get your mind right, the psychology behind trading, and not only trading, but all things investing and finance related. And I appreciate you taking the time to watch this video. Put your thoughts and questions down in the comments of the video. Until next time, I'm out. See you.